Okay.
This is the place where I bribe my child when we're going to go out and I'm making her do something.
I will never go into. Well, we check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker. That's your Bloomberg Business Flash. Alex and Paul.
Thank you so much, JT. Alex Steele, alongside Paul Sweeney. This is Bloomberg Intelligence Radio. We bring you all the top news in business, economics, and finance through our lens of our Bloomberg Intelligence folks. They cover 2,000 companies and 130 industries all around the world. All right, as we have rates still trading around that 5% level for the 30-year, despite the fact that rates have calmed down a touch over the last 2 days, it does bring into question what happens with commercial real estate. Patrick Wilson, portfolio manager of Center Square Investments, joins us next. Okay, what's the REIT market looking like right now?
Yeah, so it's been very interesting to say the least to start the year. Obviously, trade policy has affected all asset classes across the economy, but in terms of REITs, we are seeing things like interest rate volatility. Obviously, REITs are a pretty capital-intensive business, so the issuing of debt and equity capital has had to be really precisely timed. I mean, just this year, we've been from a 4.8% yield on the 10-year to bottoming at 3.99. Depending on where you were in and when you were in the queue, it could either scuttle or even postpone some of your debt and equity issuance on that front. So it's been times where we've also seen development starts year to date have also slowed on the REIT side and commercial real estate as a whole. And obviously that relates to the tariffs and the threat of cost overruns and whatnot being a little bit more difficult to forecast. And so it's kind of taking a wait-and-see approach to the market a little bit.
So in the commercial real estate space, how's the deal flow been? It just doesn't seem like I'm reading a lot about deals getting done.
Yeah, it's a great point. There's if you roll back the clock, we actually came into this year at very healthy levels. That was when the agenda on the Trump administration was going to be very pro-growth. People were a little bit more gung-ho and more optimistic about our economic outlook. And then as we roll through early April and what's occurred since, there's definitely been some trepidation coming through. And so we've seen things like property transactions by count, so property transaction count and portfolio acquisitions, larger M&A deals, certainly get postponed or in some cases possibly even pulled back as a result of just not having that same amount of confidence on where the economy is heading.
What areas in the market can kind of weather this storm, right? Like we obviously have the data center build out, but even that has been trimming around the edges, right? And sort of changing the type of investments that's going into AI and data centers as well.
Yeah, so you're speaking more broadly to just areas where you could...
Yeah. Well, typically, like the bull case for REITs was data centers, right? But then now it does feel like that narrative is not changing, but shifting a little bit and trimming. Like maybe we're going to go more to the inference stage. So you need to build different types of centers in different areas versus the huge behemoth data centers.
Yeah, no, that's definitely fair. You're speaking to the transition from training in data centers, often far flung where power and land was widely available, to now bringing it more to the inference phase of the data center build out, which has to be closer to population density. So what we see here is that making its way into Main Street America, where we start seeing, Microsoft Copilot being integrated into your workflows, and that has to have a lower latency. So we're in the crux of kind of that transition. We've seen over the last few quarters more and more discussion around inferencing truly taking place in the data center REITs. So those would be Digital Realty, ticker DLR, Equinix, EQIX. Those would be two platforms that are starting to speak to where they have a greater amount of network dense co-location and facilities where that latency does matter, and you start to see that AI inferencing take place. And so that's kind of a new phenomenon over the last few quarters.
So as Michael McKee walks into the studio, I naturally think of senior housing. Talk to us, Patrick.
Wow. Wow, that was harsh.
That's got to be a long-term bullish story in your space.
Yes, it is. At Center Square, we really do have a very optimistic view and outlook for the senior housing space. So we in the demographics, not just in the U.S., but across the globe, there is the concept of the baby boomer generation moving through a bit of a, pig in the python, if you will, as we move through that age cohort. And they're sitting on a profound amount of equity capital in their homes. So the capacity to pay is very, very high. And demographically speaking, and this kind of speaks to that secular demand that we're targeting at Center Square right now to kind of buffer any economic weakness. What we see is the CAGR in the 80-plus population that we've seen over the last really 20 years has been hovering at 1.5%. And starting about next year, that CAGR will increase to 4.5% of that 80-plus population. And we don't see, real estate being a very supply and demand-driven industry, we don't see really any supply on the horizon that will satiate that uptick in demand. So combining the capacity to pay along with the really, really favorable demographic-led demand coming through, we see that to be very, very favorable for senior housing going forward.
All right, really great. Really appreciate it. Come back. We'd love to get a continued update from you. Patrick Wilson joining us on the REIT market and where there is still value. Patrick Wilson, portfolio manager of Center Square Investment.